Hello, everyone. Brett Sebion here from Emerge 360 to give the Q2 market and economic overview. Remember, Emerge 360 is a division of TrustPoint, and TrustPoint investment team manages the Emerge 360 portfolios. So throughout the presentation, you will see the TrustPoint brand. Hope everybody is having a safe and fun summer. Markets have done a lot better to start 2023 than they did in 2022. So that's a little bit of a sigh of relief. We'll let you know kind of what TrustPoint thinks of that, changes that we're making, etc. So unlike 2022, where we had stocks and bonds both down, both had a very challenging environment in 2022, 2023 has been just the opposite. We've seen a rally in not only the stock market, but also the bond market. So here are the fixed income returns amongst different asset classes. Again, year to date, we have global bonds up about 3%, US bonds up about 2%. So in 2022, both asset classes were down, around that 8 to 10% range. That was really a function of higher interest rates, right? So as interest rates rise, bond prices fall and vice versa. So in 2023, while rates remain elevated, they have came down a little bit, which have allowed bond prices to go up in value. So again, all the different asset classes in the fixed income markets have experienced a bounce in 2023. The bounces within the stock market, however, have been a lot greater. So year to date, global stocks up about 15% after being down about 15 to 25% in 2022, depending on what area of the market you looked at. The rally so far in 2023 has been very narrowly led, and we'll get into that in a little bit. But a lot of the returns have came from the large cap growth space, and we'll talk about some individual stocks that have had a huge impact on the total returns of markets, specifically in the US. But you can see, and positive returns are welcomed. You can see that across all the different asset classes. Even the 1-year number look really strong, and then 5-year annualized looks very strong as well. But story in 2023 has been markets have rebounded within the equity market and the fixed income market. So just to touch a little bit more on how narrowly led the market bounce has been in 2023, this is a good visual. So the S&P 500, which is the largest US US companies, the largest 500 US companies, are up about 16% year to date, while the median S&P 500 stock is only up about 4.1%. Right, the more equally weighted version of the index. So what this tells us is that there's a small number of stocks that have actually carried the market in 2023, when the majority of US companies haven't really experienced that great of return. So focusing on the left side of this chart, year-to-date stock performance, it's been coined as the Magnificent Seven, which include Apple, Microsoft, Google, Amazon, Nvidia, Meta, and Tesla. Many of those companies associated with the AI boom that's been going on and getting a lot of attention within financial media, and the stocks that are associated with artificial intelligence have done really well. So the US Big Seven are actually up in aggregate close to 60% year to date, when the rest of the US is up just about 3-4%. The US market as a whole is up about 15% year to date, right? Mainly because of the Magnificent Seven that we're talking here. And globally, stocks have done well too, as really just stocks across the world have rebounded. But this just gives you a little idea of how narrowly led the returns have been in 2023, and these 7 stocks have had a large impact on the indexes, when the majority of stocks haven't experienced that return. So how does that impact our decision making within client portfolios? And when we remain defensive, even though we've experienced this bounce in 2023, we believe that volatility will continue on. We believe the US will enter some type of recession. And as a result, we're going to remain defensive within client portfolios, still participating when markets do well, but really focusing on protecting the downside when volatility comes back within equity markets. So we remain underweight stocks, overweight bonds, right? So we're favoring stocks over bonds, or favoring bonds over stocks. We are favoring value orientated stocks. We're favoring high quality fixed income, underweight corporate fixed income. So again, even within each sub asset class, we remain defensive, as well as being underweight equities relative to our target. So for example, if you are in a balanced growth strategy, we target about 50% stocks, 50% bonds. What this is telling us is that we're about 7.5% underweight stocks, 7.5% overweight bonds. In some of the recent portfolio changes, so everything in gray is things that we've already talked about in previous market overviews. We did make a change in the end of June, early July, within fixed income part of client portfolios that allowed us to become more defensive again. So this trade increased our exposure to longer term treasuries and decreased our exposure to shorter term treasuries. So up to this point, we were overweight short term treasuries, stayed very short duration. But as economies, struggle the back part of 2023 and into 2024, and equity markets experience volatility, longer duration assets, longer term treasuries tend to outperform in that type of environment. So that was the most recent trade we made within client portfolio, still maintaining the same overweight, underweight relative stocks to bonds, but within fixed income part of portfolios, getting a little bit more defensive. So that is all I have. I'd like to thank everybody for sticking with us, having the long-term mindset, being patient. Really appreciate everyone who is a client, and I'm always happy to take calls offline. So feel free to call in if you have any additional questions. But I hope everyone enjoys the rest of their summer, and we'll see you in Q3. Thank you.